Hey, it's Jeff Green with Green Financial Group. Thanks for tuning the video blog today. Today we're going to talk a little bit about Biden's proposed tax plans and what all this spending really means to you. Stick around, we'll be right back. So, never before have we seen the government commit to an outlay of this magnitude since really the two world wars. And tax rates are among the lowest that U.S. citizens have seen since really the inception of the tax codes. And if you take a look at what all the spending is doing and why we're, by the way, I hate to be the bearer of bad news, and I think you already know this anyway. These low tax rates aren't going to last. They're likely to go up at the end of 2021. That's the most likely scenario that we'll see. And if you look at why they're going to raise taxes, well, you take no look than what the U.S. debt to GDP ratio is, and it is at historical highs. It is at all-time highs. It's literally off the charts. It's going to be, by the time the spending is done, it will be at a 110% of GDP. Our U.S. debt will be at 110% of GDP. 37% of that is entitlement spending. If you look back to 1950, the entitlement spending, the budget for entitlement spending back then was 3.3% versus the 37% it is today. So the good news is, however, the cost to service this debt is relatively low. It remains low as a percent of GDP, primarily because of where interest rates are. That's not likely to last forever either, but currently we have pretty low interest rates, or really historically low interest rates, so the cost of servicing all of this debt remains relatively low. Now, the other thing I get a lot of on the tax codes are cap gains. Hey, Jeff, I hear capital gains are going up. What's the deal with that? Well, capital gains are likely to go up. In Biden's proposed tax plan, he has a huge hike on capital gains. So a couple of things there. First of all, if you have some highly appreciated assets, some highly appreciated stocks, and you're considering selling them, I would highly, highly recommend you consider selling them this year, or a portion of them this year, because you're not likely to see the cap gains rates where they are today in the coming years. So you're going to have a higher tax rates or higher cap gains rates, and you're going to keep less of those assets once you liquidate whatever position is you're looking at liquidating. The other thing I get a lot of is people think that the stock market is not going to do well in a higher cap gains rate environment. Well, take a look at the chart on your screen, and you'll notice that's not necessarily the case. If you look at higher cap gains, they're just not necessarily bad for stocks. If you look at the last hike that we had was in 2013, the S&P index gained 30% that year. While no one wants higher capital gains rates, it's not necessarily bad for stocks. Stocks can go higher once our cap gains rates have gone higher. So it's not all bad news, it's not all great news, but the news just is what it is. So thanks for tuning in the video blog today. Remember, any questions, concerns, or comments, feel free to reach out to us. Remember, stay the course.